The US Federal Reserve's latest quarter-point rate cut has rattled the global markets, leaving investors divided on what will come next. Joining us here in the studio, Kyle Rodder from Capital.com. No surprises, I suppose, but we could see more coming.
We could, and I think effectively why the markets last night hit a record high, or Wall Street hit a record high, is on the basis that the Fed flagged that it's pretty much looking at 2 more rate cuts before the end of the year.
Yeah.
There was a little bit of disappointment that maybe the cutting cycle wouldn't be deeper in 2026, but we're going to have a new Fed chair by that stage. And if you look at Stephen Miron's likely voting patterns yesterday, and probably the projections that he put forward, incredibly dovish. The next Fed chair will probably mirror that somewhat. So investors are still hoping for that deep rate cutting cycle that will, probably be in sort of stimulatory territory come this time next year. And again, that's enough to keep this kind of bull market running.
Why did the Fed, knowing that there's all of this going on behind the scenes and the drama's really going on inside the Federal Reserve as opposed to outside, why did they opt for a quarter point as opposed to going higher perhaps and getting it out of the way?
Well, it's a good point, and there was the potential of more division on the Fed than we actually got, and everyone was sort of talking about how remarkable the consensus Jay Powell was able to muster, obviously knowing that Stephen Miron was always going to go 50 basis points. The question was, and we spoke about it last week, whether guys like Christopher Waller, who's basically on the shortlist for Fed chair, as well as Michelle Bowman, who also dissented in the meeting prior for a 25 basis point cut, voted for 25. Now, the economic rationale there, to perhaps give them a good faith sort of argument for 25, was that we've actually seen some solid retail sales data this week, and there is still caution about where inflation is going before the end of the year, and the Fed acknowledged that. The counter argument to that is that they wanted to provide some kind of a united front, defend Fed independence, and sort of pretty much defend the institution and institutional credibility. Could be both of those things in terms of what motivated it, but more or less what we did see is the Fed saying that it expects to cut rates 2 more times in the final 2 meetings of the year. That wasn't in their previous economic projections, so it was pretty dovish, but it was sort of a united front, especially considering that we had Miron come in and vote for that 50.
Now, the markets obviously have been pricing this in, and that is always the case, that they have these expectations. And generally we're seeing that the Fed, the RBA, they're not moving until the markets really have priced it in, right? So we kind of know what is coming. Well,
in principle, yeah. I mean, if we talk about the RBA, a few weeks ago, they did sort of pull the rug from underneath the market by keeping policy on hold, even though there was a rate cut fully priced in. The argument is that, central bankers should pretty much guide the markets and, in principle to households and businesses and everything like that towards a rate cut before it happens. One, it makes sure it ensures that, the markets are stable on the day of the decisions and things of that nature. And for the United States, that's very important because volatility.
Never tell the market something it isn't expecting.
Well, yeah, I mean, in principle, that kind of guidance has a stimulatory effect on the economy anyway, and leads the markets and subsequently financial conditions to sort of loosen ahead of the event. The question is always obviously in the guidance, and the guidance probably diverged a little bit with where the markets were pricing, but once more, there was enough there for markets to feel kind of confident that the Fed's telling us that they're probably going to go in October, they're probably going to go in December as well.
So Jerome Powell's comments, he obviously came out and spoke about this. It was pretty clear during his comments that everything was referring to President Trump, right? He was talking about it's their job to make sure that there's price stability. Yeah. And really, the price instability has come from a lot of the things we've seen from the White House. Yeah,
there is a large degree of that. I mean, you could argue that maybe Fed policy over the last few years has added some degree of interest rate volatility and inflation volatility because they were slow to act, obviously, after the pandemic. But I mean, I think what Powell is trying to really reaffirm is that the Fed prizes its independence very, very highly, that they are not a political entity and they don't consider, political considerations when setting policy. And, he says this every meeting, we act in the best interests of the American people based on the mandate that is delivered to us by Congress, which is to kind of a preemptive way of saying, if you ask me questions about the president, if you ask me questions about my job, I'm not going to answer them because this is what we're doing. We're focused on this. So really, it's quite a good strategy. It makes his life easier so he doesn't have to get caught up in all the noise, the political noise. And also from a just pure policy point of view, it maintains the Fed's credibility that it's, pretty much trying to do its job in the best interests of the American people and the mandate that they've been given by Congress.
So what we heard from his comments after the decision was made, Jerome Powell, do you believe that this is the beginning of a cycle or is this a one-off?
Well, it's not going to be a one-off, but it's to what extent they cut interest rates in the future and take potentially policy into accommodative territory What that effectively means is that there was a lot of, first of all, the markets kind of sold off at the start of the press conference because he did kind of acknowledge upside risks to inflation and kind of phrase things as a risk management cut, so making things that sound like they'd be quite incremental. There was subsequently a rally during the press conference when he started to talk about the balancing, or the rebalancing of risks to the economy and shifting away from a focus on inflation risks to the labour market, which would indicate, considering the deterioration in the labour market that we've seen recently, more policy easing will come about to obviously support that. This is kind of where things become a little bit more sort of technical and where markets are getting caught up in at the moment, is that in principle there's always a neutral rate when it comes to interest rates that are kind of neither accommodative nor restrictive. At the moment the Fed is in less restrictive territory, so the rate is above that neutral level where the economy would be on an even keel. The markets are pricing in that the Fed will cut rates below that level to sort of stimulate the economy. Myron, for example, has voted in favour of that. There's the belief that the next chairperson might be in favour of that too. The Fed is more or less saying we're going to lower things enough just to keep things on an even keel, keep things reasonably neutral, but there's not going to be very stimulatory measures coming through. And that's...
Which is what Trump wants.
Trump wants stimulus.
Yeah, and obviously the markets do too, because they've been somewhat disappointed by the Fed's messaging since.
Yeah, pretty much. This is the thing, and something that we brought up last week is that one of the reasons why I think the markets are continuing to rally despite the deterioration in the labour market is there's the belief that the Fed is in front of the curve and they're going to be able to cut rates into stimulatory territory and keep basically this bull market running. That's still in the price, but Powell's commentary didn't really back that up yesterday. Again, the big caveat is it's not going to be around come May next year. So everyone's gone, anything beyond the start of next year, we can discuss
now, essentially.
Coming close to it, coming close to it. So he still has a lot of power to be able to obviously guide policy expectations into the start of next year and obviously continue to cut interest rates. But increasingly the markets are going to be looking at this as a tale of two Feds. One that's going to have Powell, the kind of cautious and neutral fellow who's talking about risk management cuts and not cutting rates into stimulatory territory, and whoever comes next who is likely to be the opposite.
Yeah, and which we know means that Trump will get what he wants, obviously, here too.
Yeah.
Talk to us about the US dollar's response, because it initially dipped and then rebounded.
Yeah, it's a really interesting dynamic because there's the argument that the dollar is a better reflection of the change in the interest rates curve in response to this decision. Again, just to sort of lay out what we got and what was expected, we did get probably a little bit more easing in the summary of economic projections forecast than the markets had priced in. But in terms of 2026, we were talking about market participants betting on a policy rate below 3. Yeah. They're saying it'll be mid-3s. So as a result, we have had incrementally the markets coming a little bit closer to where the Fed is forecasting things for next year. That has an effect of lifting yields a little bit. Higher yields means typically a stronger currency, and therefore the dollar lifted. So it's one of these questions of, are equities ignoring the signal here because there's that kind of divergence in behaviour that sort of suggests that stocks are continuing to rally despite the fact that there are fewer rate cuts being priced into the market, and that's, to your question, what's pushing up the dollar.
And obviously what happens in the United States isn't always exactly followed by the rest of the world, but it is watched pretty closely by the Bank of England, the RBA as well. We're all facing very similar situation post-COVID with inflation. What do you think they'll be reading out of this, particularly the RBA?
Well, I mean, if they do start to run policy a little bit more accommodative, it's going to have a tailwind effect on the rest of the globe. And then there's also questions about the currency channel and to what extent that might feed through into inflation and inflation expectations domestically as well. But I mean, I think if you were to ask this question of Michelle Bullock, she would say that she's very much focused on domestic fundamentals and economic conditions, and they're going to be fairly focused on the labour market and inflation going forward. And what's happening in the United States is an input, but something that they don't really set policy around. In the bigger picture, a more accommodative Fed is good for the US economy. What's good for the US economy is good for the rest of the world. So one would hope that whatever the Fed does, it is indeed setting policy that is in the interest of the US economy. But yeah, for the most part, we're kind of travelling on our own path at the moment when it comes to Australia, because our policy conditions and economic conditions are a little bit different at the moment.
Yeah, of course. Colorado, appreciate your time. As always, thank you.
Thank you.